How can you maximize your retirement income in a low rate and possibly low return era? But we're joined by three retirement pros who have some answers for us. First up is the editor of Kiplinger's indispensable annual retirement planning guide. She is Mary Beth Franklin. She's senior editor of Kiplinger's Personal Finance Magazine, who has been honored for her retirement coverage. And next is a newcomer to Wealth Track. He is Harold Evensky. He's president of the financial planning firm Evensky & Katz. He has been cited as one of the 5 most influential people in the financial planning profession by Financial Planning Magazine. He is a prolific speaker and author, and among his books is the award-winning Retirement Income Redesigned: Master Plans for Distribution. And finally, we welcome back a Wealth Track regular. For 18 years, Jonathan Clements was the widely read personal finance columnist for the Wall Street Journal. Now he is Director of Financial Education for Citi Personal Wealth Management, and he is the author of recently published The Little Book of Main Street Money, which is on our recommended Wealth Track bookshelf. So welcome to all of you. It's great to have you here. So this is a pretty important topic for our viewers out there, maximizing retirement income. So Mary Beth, let me start with you. You say we should basically break it down into 5 different stages. So do you want to take us through those stages quickly?
Yes, people in retirement should think about segmenting their money,
Right.
that it shouldn't all be invested at the same time for the same purpose.
And why is that?
Well, in the early years of retirement, your first 5 to 10 years of retirement, you should be all about guaranteed income. Now, in a higher interest rate environment, maybe you have a bond ladder, maybe you have a CD ladder, but interest rates are at historic lows.
Right.
So you might want to think maybe a short-term immediate annuity, a 5-year annuity, guarantees you income, lets you sleep at night, and have the rest of your investments invested for the long term. The idea is you want to have enough guts to stay in the market when it's tough, knowing you've got a paycheck coming in every month.
That's a very interesting starting point. Would you agree with that, Harold and Jonathan? Is that something that you would recommend? It's interesting because I would think a guaranteed income is something you'd want later in your retirement, not like right off the bat.
Yeah, the answer is absolutely for a big part of it. We call
Right.
our 5-year mantra. We don't believe anything should be invested unless you've got a 5-year horizon. That's where the risk is at the beginning. So if you put money in stocks or bonds for that matter, there's too much risk, you're going to take it out at the wrong time. So that provides a huge safety valve by having that 5-year cash flow.
Now, I know Jonathan agrees with this. I mean, you wrote an article recently about kind of, saving your retirement in a bear market. So what's your take on that approach and on this incremental approach?
Well, I think there are a variety of strategies that you can take to generate retirement income. But the strategy that Mary Beth is referring to, this idea of having some sort of cash cushion, I think that is a great way to go. I mean, one strategy you could consider is, say, I want to make sure that no matter what happens in the market, I'm going to be okay for the next 5 years. So you take 5 years of the withdrawals that you expect to take from your portfolio, you take it aside and you put it, say, in a money market fund or a short-term bond fund, and then you can take the rest of your portfolio and you can invest it for long-term growth. You can put it in riskier bonds, you can put it in stocks. Every year, if you have a good year in the market, you can cash out some of your gains and replenish this cushion of cash that you have, this 5 years of living expenses. If things are rough, then you leave the long-term portion of your portfolio alone and you just know that you have that 5 years of living expenses to carry you through the next 5 years if the markets are rough for that long.
So I mentioned, Mary Beth, that there were 5 stages. So take us, what's the next stage that you would recommend?
Well, if you took this idea of buckets of money or segmentation in 5-year intervals, you want guaranteed income the first 5 years, and a variety of ways you can accomplish that, and a pretty good sense that the years 6 through 10 are virtually guaranteed. Beyond that, broader stock indexes maybe for 11 through 15, and beyond that, maybe some more alternative investments. The idea is with each pot of money, you have decreasingly smaller amounts of money invested in slightly riskier potentials, because if I don't have to touch that money for 20 years, even if I'm only investing 5, 6, 8% of my portfolio, it has a pretty good shot of returning a decent return, but I don't have to touch it for 15 or 20 years. The other thing I'd love to bring up is not only how you invest your money, but where you keep it. I think one of the biggest mistakes early retirees, new retirees make is they've been plowing all their money into IRAs and 401ks. That's where all their money is. And when they need money, they're taking it out of a retirement account that they're paying taxes on every dime. I think it's very important as people approach retirement, they have cash in a regular taxable account. money that they're just going to take out. It might just be capital gains, but you're not going to be paying taxes on every single penny.
So Harold, where do you let's start from zero with you. So what's your approach? The question is, how do I maximize retirement income? What's your
really
first
fairly similar.
principle?
I might be concerned about 5 buckets, but we carve out literally 2 years worth of someone's cash flow, supplementary cash flow. The problem with 5 years, there's an opportunity cost of having it sit in cash. The balance we call the investment portfolio. We design that for a total return, so that's going to be a mix of stocks and bonds. As we manage that portfolio, we make adjustments. We rebalance, something goes up, we sell, we look over and say, gee, you're down to a year, let's replenish it. So that 2 years is always going typically somewhere between 6 months and 2 years. The balance of the portfolio is between stocks and bonds is a function of what we determine the client needs in terms of a long-term real return over inflation rate. Typically, baseline would be 40 bonds, 60 stocks. We've got some clients that may as much as 80% equities. People that have a lot more and smaller demands might be all bonds. So that's very unique to the individual.
And the other thing that you told me on an earlier conversation was that, on risk, understanding your risk tolerance, but also your risk profile is very important. So figure that into...
We call it anchoring on the efficient frontier. It simply means what return you need and what can you live with between here and there. If we're lucky, someone can live with a stock volatility exposure that when everything goes wrong, they'd be miserable, but they won't say, I can't stand it, sell me out. Mm-hmm. If we conclude they can't, then our advice is then change your expectations, because the worst of all worlds is to invest and then bail out like last year. Those people will never recover. We define risk tolerance as that level of pain when everything's going wrong. You may be miserable, but we'll be able to hold your belt and suspenders and keep you invested, because that's the secret, is staying there.